Global equity markets are currently projecting a level of stability that is at odds with the physical state of the global supply chain. In the United States, the S&P 500 recently pushed back above the 6,800 level, successfully reclaiming its 100-day moving average. European indices mirrored this price action. The Pan-European Stoxx 600 recorded its strongest single-day performance in over 4 years. But this index-level price action is deceptive. Beneath the headline numbers, the historical correlations that define market stability are beginning to break down. Relying on this equity rally without analyzing the underlying physical commodity constraints creates a risk of significant capital misallocation. The primary catalyst for this sudden market exuberance was a 2-week temporary ceasefire between the United States and Iran, negotiated during marathon peace talks in Islamabad. The formal announcement of this pause triggered a rapid deflation of the geopolitical risk premium. Europe's primary volatility gauge, the Stoxx Volatility Index, dropped below the 25-point threshold as institutional hedging began to decompress. That diplomatic architecture lasted only hours. Secondary regional conflicts resumed almost immediately, marked by heavy military airstrikes across targets in Lebanon. Iranian authorities responded by declaring the baseline conditions for negotiations void and reclosing the Strait of Hormuz to all commercial maritime transit. The collapse of these negotiations suggests the market's expectation of normalized trade is inconsistent with the reality of the blockade. To see the impact of this friction, we have to look at the physical mechanics of the energy market. This geopolitical gridlock has triggered a dislocation in the energy market, confusing algorithmic trading models that treat paper contracts and physical delivery as identical assets. Following the ceasefire announcement, financial futures markets corrected, dropping 12 to 14% below the $100 threshold. However, the physical spot market for crude oil spiked toward $147 per barrel, creating a record premium over the futures price. This gap exists because of a physical bottleneck. Commercial hydrocarbon exports navigating the Strait of Hormuz have collapsed to 8% of their historical averages. Commercial consumers cannot fulfill energy needs with financial futures. They are currently scrambling to secure the limited physical deliverable supply that remains accessible. The European aviation industry has issued formal warnings that a continent-wide jet fuel shortage could manifest within 3 weeks if this blockade remains in place. This physical scarcity will dictate corporate operating costs and margin compression, regardless of speculative futures movements. This maritime energy shock is transmitting directly into the economic data of the United States. The Consumer Price Index for March printed significantly higher than consensus estimates, with headline CPI surging 0.9% month-over-month. This acceleration was driven by the energy component, acting as a regressive tax on economic growth. This data effectively neutralized institutional expectations for lower interest rates from the Federal Reserve. Market expectations for the interest rate timeline have undergone a hawkish repricing. The probability of an interest rate cut in 2026 has dropped below 20%, while current pricing does not suggest a structural cut until July of 2027. This creates a policy dilemma. While inflation is accelerating, domestic output is slowing. Real GDP growth for the fourth quarter dropped to an annualized rate of 0.5%. A higher-for-longer cost of capital is becoming a structural constraint, creating a narrow corridor for policymakers that threatens the stability of highly leveraged corporate balance sheets. This macroeconomic pressure is exposing a breakdown in the foreign exchange market, the weakening Japanese yen. The yen has historically served as a premier safe haven asset, appreciating against the dollar when global geopolitical strife or market volatility increases. That correlation has inverted. The US dollar to yen exchange rate recently breached the 160 threshold, even as geopolitical risk increased. Statistically, the yen now tracks energy costs over risk appetite. The dollar-yen pair exhibited a 0.95 correlation with Brent crude oil. Simultaneously, it shows a direct correlation with the VIX, weakening precisely when market volatility rises. This shift is driven by Japan's status as a net hydrocarbon importer. Rising energy costs act as a continuous drain on the nation's current account. Bank of Japan Governor Kazuo Ueda faces a dilemma. Raising interest rates defends the currency and curbs inflation, but risks stalling Japan's fragile recovery. Verbal warnings of intervention from the finance ministry have had only a temporary effect. Without changes to monetary policy from the Bank of Japan, the currency remains under pressure. The stress in the currency market is now affecting Japan's domestic sovereign debt. The Japanese government bond curve is experiencing a bear steepening, with 20-year yields rising significantly. The intensity of this shift is visible in the ultra-long 40-year yield, which spiked by 29 basis points in a single session to breach the 4% threshold. This localized volatility in Tokyo is transmitting to global markets through the unwinding of the global yen carry trade. Historically, Japanese institutional investors have borrowed in low-yield yen to purchase higher-yielding foreign assets, such as U.S. Treasuries. As domestic yields hit multi-decade highs and yen depreciation erodes the returns of foreign bonds, the incentive for this trade is disappearing. Capital is being pulled from international markets and repatriated back into Japan to rebalance portfolios. This repatriation is exerting upward pressure on global yields. Following the sell-off in Tokyo, the U.S. 30-year Treasury yield spiked to 4.9%. A failure of the Japanese bond market to stabilize could drive sovereign borrowing costs to new cyclical highs across Western economies. As the first quarter earnings season begins, the data is revealing a bifurcation in corporate resilience. Companies in the semiconductor and artificial intelligence sectors remain largely immune to these macro pressures. Massive capital expenditure on AI infrastructure provides a secular tailwind offsetting the rising cost of capital. In contrast, the consumer discretionary sector is showing signs of severe distress as discretionary capital evaporates. LVMH serves as a case study for this decline. During the first quarter, the leading luxury conglomerate saw its share price drop 28%. This war discount reflects a shift in consumer behavior. Elevated inflation and disrupted travel are eroding the middle-income aspirational consumer base that previously drove volume growth in entry-level luxury. This contraction in luxury valuations serves as a leading indicator that the global consumer is under significant pressure. These combined pressures will dominate the agenda for global policymakers convening at the IMF and World Bank spring meetings in Washington, D.C. The IMF projects long-term scarring effects across global supply chains, suggesting that there will be no immediate return to the pre-war economic status quo. Corporate treasuries must adapt. Foreign exchange exposures require aggressive hedging as funding currencies remain volatile and the carry trade steadily unwinds. Capital structures must be optimized to survive a period of restricted liquidity and elevated risk-free rates. The evidence suggests that the global economy has entered a supply-constrained stagflationary cycle. In this environment, rigorous cost discipline and defensive capital preservation are the only mathematically sound methods for navigating the contagion.